One of the most important books for every long-term investor or every investor who wants to create wealth over the long term is The Intelligent Investor by Benjamin Graham. However, the last edition of the book, which has been sold in a millions of copies, has been written in 1970, which means that some parts of it are outdated or they aren't. So I am going to go through the chapter of the book today. We'll do a chapter 1 and we'll put it into today's perspective. What was going on then? What's going on now? The learning is essential to understand how to position yourself in this market in a perspective of your life investment cycle. So stay with me today. Chapter 1, the distinction between investor and speculator. Let me quote Graham: an investment operation is one in which upon thorough analysis promises safety of principal and adequate return. Operations not meeting these requirements are speculative. The key with Graham, Buffett, Munger, whoever, whatever value investor is, don't lose money, and don't lose money. If you don't lose money over your lifetime, you'll do very well. And that's also the key to Benjamin Graham. Whatever investment of speculation, that there is a risk of permanent capital loss. As Munger would say, that is the speculation, and that's something that should be approached very carefully if one must do that, and not with the big part of the portfolio. So investment means no chance of permanent capital loss. What's very interesting from book is that was written in 1970, and this is this chart of Dow Jones index from 1948 till 1969. As you can see, is a very similar to what stock did in the last 45 years. Some ups and downs, some huge down as we have seen in 2009. But stock level went only up and the S&P 500 and even the higher in that period. So the market then in the 1970 performed terribly in a subsequent 12 years, 15 years and 20 years. It took to more than 20 years to reach the same level. So that's something we might expect too, and that's why the book is too important to be read. Now, further, Benjamin Graham says that in 1969, where stocks were extremely high, extremely pricey with high valuation, everybody related to the stock market was called an investor. Like now, if you put your money in a stock, even in a cryptocurrency, investing in a cryptocurrency in a 1984, where nobody wanted to look at the stocks. Stocks were condemned as a speculative, as a casino, as a gambling place, not something that the decent person would do. Do you see the difference in the returns? 1948, 1968, 69, 1970. The difference in returns you have to invest when nobody wants to invest, and you have to be very careful when everybody, even your dog, thinks that he is an investor. So think about that is the long term investment cycle. Graham tells it's very simply about speculating. Speculating is always fascinating and it can be a lot of fun while you are ahead of the game. Never add money to this account just because of the market has gone up. That's the time to think taking money out of your speculative fund. So, to whom should we listen? To Benjamin Graham or the plethora of investment advisor who tell us to invest in index fund? Because if you invest in index fund, you cannot lose. Well, if they go little bit more in a history, you can lose a lot. Especially if stocks are extremely expensive like they are now. So, what does Graham advise? And this is very important. He differentiates between the defensive investor, one who doesn't take any risk, and the aggressive investor, which I think most of my viewers are, who want to beat the market. And he says that we can beat the market. Let's first discuss the defensive investor and then how to beat the market. So the defensive investor is one who interested in a safety plus freedom from bother. Graham's advice is a simple: hold within a 25% and 75% of your portfolio in a bonds or stock and rebalance when the market is dangerously high. So when the market is high, 75% bonds, 25% stock. When the market is safe, 75% stock, 25% bonds. Remember, Buffett has about 40% of his portfolio in a cash now. So what do now? Bonds are yielding more and more, especially if you buy short-term bonds that give you 2%. You have a no risk and you will see in a year, 2 years, what will be the best investment sometimes, especially now for defensive investing. R1 who doesn't want to think a lot, short-term bonds, even treasury inflation protection bond might be the way to go. Big part of the portfolio defensive over their portfolio. You don't care what happens, you don't lose money and something. You live in a stock, okay, and then you rebalance accordingly. If that if that even increases even more, or if that drops, you sell your bonds to buy better stock. What can the aggressive investor do? There are three ways that Graham says you can beat the market. One is trading, second is short-term selectivity, buying stock of company reporting or expected to report increased earnings or were there other catalysts, and three is long-term selectivity, buying great businesses, even great tech companies that will do well over time. Graham is against trading because that he says it's a fool game, so you win some, you lose some. If you must trade, okay, trade, but with the small part of your portfolio and then sell when you're winning. Secondly, short term situation, he says everybody looks at them, so those are usually priced in a price of the stock market. So as always, Graham says long term perspective on the stock market is your best advantage to quote, to enjoy a reasonable chance for continue better than average result. The investor must follow policy which are one, inherently sound and promising good investment. Thus, my addition and still not popular on Wall Street. In addition, Graham says arbitrage opportunities, merger and acquisition, liquidation, and then he says something is very important which is very much related to now. Final example of golden opportunities not recently available. A good part of our operation on Wall Street has been concentrated on the purchase of bargain issues. So back then it was difficult to find such investment. You know the long-term result for the 15 years have been terribly negative. Now we are in a similar situation with long-term investment result being negative for those who are not prepared or those who are not specializing their investment into detailed investment that will beat the market in the next 10-15 years, or result will be negative. As usual, thank you for watching. If you like what you see, don't forget to give thumbs up before you leave, and also consider subscribing if you haven't subscribed to this channel.